Hey traders, Raghee here. Welcome to Charts and Coffee for Monday, November 1. It is November. How did that happen? So that was pretty quick. This year's been flying by. And we wake up this morning to, well, what kind of mood is November in so far? Pre-market, pretty darn good one, gap up. We continue to see some of the strength that we saw since about the middle of October on. Probably one of the most, I'd say, most commonly asked questions that I've been getting so far, I'd say definitely the last week, is are we back in an uptrend? And this isn't about what I think. It isn't about seasonals. It isn't about all the things that I think we're seeing play out in terms of, what happened to October, right? Wasn't the world supposed to end last month? Don't know. We know that the seasonal factors can only be applied if we have a much more powerful factor, meaning the central banks sort of creating that environment. And so we've gone double green the last couple days of the last couple days of October, kicked that S&P back into a double green. And this doesn't mean we buy it per se. It simply means that it's once again buy the dippable, right? That's really what we're focused on. What strategy does that double green create? Same thing with NAS. Now, nothing has changed about the way in which I will engage these markets, and that's still going to be at the sector level. So, when it comes to the NAS, the relative outperforming corner, when it comes to the S&P, the relative outperforming corner, absolutely remain the same. When it comes to the S&P, the relative outperformer to the downside, right? Still the same. And I'm not ruling out the XLV maybe going double green, but it's still very much in chop. And then we can take a look at sort of related sectors to tech. We can start wandering into CLOU and SMH and things like that and start getting a little bit more detailed about if there are corners of the market that we want to focus on the sectors for to buy the dip. That's fine. In fact, that's not changed since October, and we had the choppy indices. So I don't mind to not be engaged to the long or short side in the indices. Our focus has continued to be, when in chop, focus on the more specific strength or weakness at the index level, at the sector level within the index, and at the stock level within the sector. Okay. All right. So that's how we're kicking off November. And I still like the long energy play. I still think long energy is still a very good play. Crude oil, the CL futures contract, RBOB gasoline is a bit of a laggard, but I wouldn't rule that one out. Natty gas has been a little bumpy, but again, wouldn't rule that one out either. So I like the long energy. And then, of course, oil stocks go along with that conversation. This has been probably one of the more persistent strength stories within the market that are staying double green, convincingly so. And so remember, if you're looking at crude, if you're looking at RBOB, if you're looking at Natty, until they go double red or until they really lose their bullish structure and start going yellow, we definitely want to think about sticking with the long side. And you guessed it, buy the dip. All right. So happy Monday. Happy November, everybody. Let's kick it off with your questions. First off is, I only day trade. Hey there, Dan. And only NQ and ES. Okay. I found the last month or so to be difficult. So I switched to 5 and 10-minute charts, cleared things up. Does that make sense, or is that a coincidence? In chop, Dan, when you have choppy markets, and I don't know the process you're using, Dan, but when you're looking at choppy markets, yeah, it wouldn't surprise me at all to see the 5 or 10 or whatever longer term time frame is giving you some better clarity. But if you're getting better results, I'll tell you straight up, what's it matter? Stick with it. Yes, try to figure out why that's happening. I mean, clearly I don't have enough to work with to say that. I think really what I would say, Dan, is I'm not a fan of only trading two things. But if that works for you, perfectly awesome. So I think you found something that works. And as long as you're controlling risk, sometimes the best thing we can do is just not overthink it, right? If it's working, Stick with it. The gods of trading have smiled upon you, and there's no reason to question it as long as you're controlling risk and making structure the priority. So good stuff there, Dan. And by the way to go in that you noticed something wasn't working. You didn't keep banging up against. You said, okay, what do I need to modify to get some clarity? That's the most awesome thing. So fantastic. All right, happy November, everybody. Absolutely. All right, so next up, wouldn't the Fed announcing reduction purchases drive bonds down, the price of bonds down? So remember that the yield. So let's use ZN because of the 10 and 30, the ZN is actually the better of the two. So two things. One, sure, we can say a lot of things. A should cause B. That's fine. But remember, no market has a singular catalyst for why it's moving, right, Andres? So if we have risk appetite in equities, well, bonds are not going to be in demand, are they? Not as much, right? That's the causation, one of the causations for bond lack of demand. And lack of demand means lower price, and lower price means higher yield. So always remember that the relationship between the direction of the futures contract and the direction of the yield are opposite. But as far as the Federal Reserve announcing a reduction of the purchase of bonds, shouldn't that drive then yields higher and the futures contracts lower? Andres, this is where discounting is probably the best answer to that. None of that is top secret, right? I mean, we all know that it's been out there for a long time. We've had a lot of time to think about it. And if we've had time to think about it, that means we've had time to adjust to it. In other words, discount that into our price action, into our strategy, into what we're doing next. So while the answer is definitely, I would agree with you, I also want to say that there could be multiple reasons, multiple influences on a market. And if that's not influencing it, then we just trade what we see, right? I mean, that's kind of the answer to that one. Just trade what you see. All right, next up, what's up with Natty Gas? I think that when you look at Natty, Larry, when you look at Natty, natural gas, whether that be NG futures or the UNG ETF, remember that one of the major catalysts for the movement lower was Russia. And I think last week, Putin basically, that's your OPEC plus, right? We found out that OPEC plus was cranking out more crude oil than the production increases were expected to be. And then they're also supplying, I believe it was Germany and some other countries with more natural gas. So again, they're actually also supplying them with more. So more supply by way of crude and by way of natural gas is hitting the market. And that was a pretty significant, especially to natural gas, blow to natural gas, because what are you always balancing? Supply and demand. Supply is bullish. Lack of supply is bullish. Low supply is bullish, right? Demand is bullish. So you think about, all right, what's driving this? We have more supply. Well, that would be momentarily bearish, but that bearishness of Russia supplying, say, Germany, and I forgot who else they were supplying. But that narrative is also being met almost like a collision course with demand. So knowing that the trend was up before the chop, I'm going to stick with that side of the market. So as long as I know sort of at least what I think the major catalyst was, and it's not one that has broken the trend per se, and the trend preceding this current chop is this is choppy, but it's still pretty bullish because I've only had one red grab candle, and that's not really enough to concern me about maybe a more sustained move to the downside. So I'm still bullish. I'm still I'm long natural gas via a lot of calls in UNG. They're so darn inexpensive. It's such an easy way. I think a lot of folks in the Sector Secrets Mastery in the class that I'm running right now, the ETF formula class, are realizing, one of the easiest ways to control risk, one of the easiest ways to manage your trading in regardless of the size of your account is inexpensive options. And by the way, by inexpensive, I mean usually $5 to $7 or less, right? It's not uncommon for the bulk of my position to be in two, three, $4 options, $5 options, but have more of them. So the way in which I increase risk and increase potential profitability of my trades is to have more of a particular unit, but the unit is the risk in this case, and the cost is smaller per, right? Let me put it this way. If you're trading an expensive stock where you're buying that stock option for $40, $50, what I'm saying is you've got one of those, maybe two, and you've had to do all sorts of multi-leg option gymnastics to make that affordable or even low risk, suitable for your account. However it is you sort of massage that. What if you bought 10 $4 options? What if you bought 20 $2 options? The net effect is the same. The risk is less. The scalability is infinitely better. So those are things that I'll think about. All right. FOMC taper announcement is a threat. Not if we know it's coming. Not if we know it's coming. It goes back to discounting, Shane. If we know something's coming, look, let's think about it in fighting. I love MMA. I love boxing. If you know that your opponent loves to throw a wild left, right, and you know that's where it's coming, right? I mean, how many of you remember you're blocking from martial arts, whether it's a low, whether it's a high? If you know it's coming, you can adjust. That's no different in the markets. If I know that's what my opponent's doing, I've already made adjustments, right? I've already changed my stance. I've already tightened up whatever it is I need to do to protect myself. So that's how I look at anything that is really obvious. It's kind of looming over the market. That's why it's often said, and I've talked about this through August, when people ask me, is the market going to crash? I said, the mere fact that we're talking about it, the mere fact that it's being discussed in the interweb and television is the reason it will not happen. And that's actually panned out to be true. If everyone's expecting something, what has happened? We've discounted for it. We've adjusted. We've made the specific moves we need to do to protect ourselves. So crashes never come when everyone's talking about crashes coming. That's sort of the irony of it, isn't it? No one saw really in a wide way, when did, for example, television and even the internet start broadly discussing the Evergrande, when that was one of the catalysts for some weakness early. Who's talking about that until it happened? That's the way sell-offs happen. It's usually something we didn't see coming. What finally knocks a fighter out? That, they get hit in the button. They just didn't see that punch coming. So that's why I look at it. What did we not cover for? So if you're wondering about threats, let's just look at it more generally, Shane, as far as threats. If you're looking at threats, think about what are we not covering for? What are we not talking about? What's sort of left exposed? And that's usually, it's going to narrow it down to a handful of things, but that's usually where you're going to find, Kathy Wood's talking about that quite a bit. There are a lot of folks out there saying, look, this is what we're not talking about. But then again, talking about it begins to reduce the likelihood that it is going to be a threat, right? That's the psychology of the market, like a dog chasing its tail a little bit. All right, next up, saw some news that Putin was slowing down natural gas supply to parts of Europe. Will that impact Natty? So he changed his mind, JMO? Putin. If he does, that's quite bullish for us and probably why we're seeing the move lower and then some bullishness. I'm not too concerned about it right now. It's sort of reminiscence of what we bought into back in mid to late October, but that would be bullish. That would be bullish, JMO. All right. So next up, Jonathan, good morning. I was literally going to ask about SPX and NDX going double green and what you think. Buy the dips, and buy the dips. Not in the broader averages. I'm still going to say what I did through October. S&P is okay. I would be very cautious with the NAS. And I would say I would be cautious with the Dow as well. Find the relative outperforming corners of those markets at the sector level or even at the stock level. And then do what you said, right? Buy the dip. Yeah, exactly. Hi there, Tom. Do I still trade Forex? Yes, I do. or does day trading mornings, ETF sectors consume all your time now? No, Tom, great question. So when I day trade, it doesn't. So everything I do now, if there's anything that I've stopped doing, it's I'm not paying as much attention to grains, meats, softs. They're not as related to what's going on in treasuries, currencies, indices, sectors as currencies, as some of these other corners of the market. So, with that being said, the reason that I don't focus on Forex as much is because I'm usually trading currency futures. Now, do I still trade Forex? I do. But the cool thing is, it doesn't keep traders who aren't interested in Forex out of currencies. There's currency ETF options, and then there's futures currencies. But no, it's very, they intertwine, right? If I look at Australian dollar, if I look at Japanese yen, if I look at Canadian dollar, they're still going to tie back to a lot of the conversations that we're having about indices and crude oil and things like that. So I do, yeah. The only reason I can do that is because they are more tied together. They're more similar and influential than they are desperate, right? They're not that disparate. Okay, next up, looking forward to live trading. Yeah, I will see you all for the beginning of live trading second session at 2 p.m., right? 2 p.m. Eastern today. Yeah, looking forward to it. All right, next up, thoughts on CSPG. Okay. Okay, looking at the CSPG. CSPG? Did I write that? Let's see that right. CSGP. Gosh, CSGP. Okay. I mean, it's at the 200. I can't say I love it. And then you mentioned this was part of the IYR. So, Tony, if I'm looking at stocks within the IYR, I'm just going to jog my memory here about some of the lower weighted stocks because I think CSPG is one of the lower rated ones, right? So if you're looking at the real estate holdings, where is CSPG? Yeah, it's down there with Welltower. It's down there with Avalon Bay, Equity. Do you see how different CSPG is reacting? It's not in sync with the tide. In fact, it's probably most out of sync. So I can't say I love CSPG, GP, whatever that is. CoStar, yeah, I can't say I love it because it's just doing something so markedly different. The whole idea of boats and tide is to see how the individual stocks within the sector are moving in unison, preferably, or maybe even better than the broader. If you're looking at CSGP, I can't say this would end up on my radar, my friend. But here's another way of looking at it. If it's going to bounce, you found a pretty good spot from which to see that happen, at 200. Although the past visits to 200 is pretty mixed. It bounced off it the last time, but it's been very hit or miss prior to that. So I would say it's likely to move with the tide, but let's just see if we can't find anything better that looks more like IYR than something that looks so distinctly different. I hope that makes sense. But the play on the 200 could be very interesting, Tony. Do I have any thoughts on Freeport-McMoRan? I've been getting some questions about copper, and I won't look at Freeport till after earnings. And I would like to focus on Freeport in some synchronicity with copper. I don't love copper yet, so it's really hard for me to love Freeport. So while Freeport's trying to go double green, remember, if copper doesn't go double green, then Freeport's going to have to sort of have another reason, right? Remember, we mentioned that there can be multiple catalysts to any market. So then if I'm looking at FCX and it's moving higher in a way that is not suggested by copper, we've got to look then at XLB. We've got to look at XME and ask ourselves, is Freeport moving with with them. Is Freeport being influenced more by other stocks within the sectors? And I would keep an eye on XLB and maybe find some other names, Deborah, within XLB to jive with Freeport. I mean, I think we just have a different catalyst here. All right. Okay. So that is our show. As always, thanks so much for all the questions. Let's see here. Couple basic questions. Kay, you had a question about stops. Ask me in the room if you wouldn't mind. I'll be happy to dive into that there. As far as silver, Tim, I'm still pretty bearish silver overall. Not super bullish. So unless it gets above the 200 and stays above the 200, I'm still pretty bearish silver. And as far as the last question here, I always say I'm done by day trading, Trader Mo, not trading, day trading by 11:30. I'm done day trading. So why am I live trading classes at 2? You're confused because you confuse my regular trading with my day trading. No worries. It's easy to do. I day trade until 11:30 in the second half of the day, which if you know I day trade to 11:30, you also know what I also mentioned is that after about 1:15, it frees me up to no longer focus on those shorter term time frames. And so if between about 9:30 and 11:30, I'm looking at 2-minute, 5-minute time frames, after say 1-ish, give myself a little bit of a break midday, and then I can look at daily time frames in the afternoon. And that's why our trading is at 2. Okay. All right. And so that's how we separate it, right? That's how we separate our minds. That's how we separate it with the hours that we have in the day. Be good to each other, everyone. I'll see you tomorrow.